Hello, everyone, and welcome back to SALT Talks. My name is John Darcy. I'm the managing director of SALT, which is a global thought leadership forum and networking platform at the intersection of finance, technology, and public policy. SALT Talks are a digital interview series that we started in 2020 with leading investors, creators, and thinkers. And our goal on these SALT Talks is the same as our goal at our SALT conferences, which we're excited to resume with SALT New York in September of 2021. And our goal is to provide a window into the mind of subject matter experts, as well as provide a platform for what we think are big ideas that are shaping the future. And we're very excited today to welcome Ali Tamaseb to SALT Talks. Ali is a partner at Data Collective, also known as DCVC, which is a highly reputable venture capital firm in Silicon Valley with over $2 billion US in assets under management. He holds several leadership and board positions at companies both globally and across the United States. He holds a degree in Biomedical Engineering from Imperial College of London and studied general management at Stanford Graduate School of Business. Tamaseb was an honoree of the British Alumni Award, Centenary Enterprise Award, and the Imperial College Medal for Outstanding Achievement. His work has been featured in BBC, The Guardian, Forbes, The Telegraph, among many other news outlets. And he's given talks at major events and conferences. Hopefully SALT is in his future as well. He lives today in San Francisco, California, despite being very much a citizen of the world. And I know DCVC does business around the world as well. And I don't want to get started without mentioning that he's also the author of a new book. It's called Super Founders: What Data Reveals About Billion-Dollar Startups. I'm fascinated to learn more about what the data reveals so we can hopefully find that next unicorn. Hosting today's talk is Sarah Kunst, who is the founder of Clio Capital and a frequent guest host here on SALT Talks. We've loved getting Sarah and her perspective involved in these conversations. And with that, I'll turn it over to Sarah for the interview.
Hi, so excited to be here and so excited to hear about what makes a super founder a super founder. So before we dive into that, Ali, thank you so much for joining us and would love to just hear a little bit more about, your story and your motivation to write this. Why are you giving away the guide so that everybody else can find deals as good as yours?
Thank you, Sarah. I'm glad to be here with you and John. I think the motivation behind this book, it started about 4 years ago. And, there's a lot of popular narratives about what makes for a great entrepreneur. And I think a bunch of that comes from media. The Social Network movie, we've all watched that. We know about the stories of Steve Jobs and Steve Wozniak, two co-founders, one technical, one business visionary, savvy. There's a lot of these famous stories. There's not actually a lot. There's a few of these famous stories that shapes our mindset about what the rest looks like. But today there's 300 something billion dollar companies that were started in the past 15 years. And they don't necessarily all look like the same or look like these couple popular narratives that we do. And it's my job as an investor to, sort through thousands of companies every year to take a bat at one or two shots and sit on a couple boards and help these companies get to billion-dollar exits. And nobody had done the work of going to the ground truths of seeing it. Was there something different about these companies that become billion-dollar companies and outcomes or not? So I decided to collect the data, and it's a very hard thing. There is some data about the financing history of startups out there on platforms like PitchBook and Crunchbase. But there's no data on the competitive landscape when these companies started, on the defensibility factors, on the career path of the founders, on the fundraising history, on the origin of the idea, on the pivots. There's a lot of factors. So I sit on 65 different factors, and I collected this on every unicorn that's been founded in the past 15 years, every industry, tech, biotech, health, energy, fintech, as well as I collected the same data on every non-unicorn, every company that had raised a minimum of $3 million in venture capital, but did not become a successful outcome. So I had some stuff to compare between the two groups. And, the findings were shocking. I decided to write a book, and I decided to interview a lot of these founders. I interviewed founders of Zoom, GitHub, Instacart, Nest, and investors like Alfred Lin of Sequoia and Peter Thiel.
That's awesome. And what did you find? What brand of hoodie makes founders most likely to be successful?
The shocking thing was that data showed a lot of factors that normally we've thought to be correlated with success are not correlated with success. And that's where the shocking and counterintuitive part is. Obviously, the data showed there's a bunch of things that do matter. So there's some truisms and there's a lot of stereotypes. And we will talk about both of them in this session. Maybe let's start with some of these stereotypes. The one that I like is about, successful founders need to have solved their own problem. They need to be, their own customer. They need to have a personal mission or personal problem. And I think you see that again, it's a little bit of that narrative bias. The bias comes from, these stories make for a good story and they make themselves into media and you see and read articles about them. But when you actually collect the data, you see that a lot of these, very successful founders were opportunity driven. They found a good trend. They were excited about starting a company. They talked to different types of customers. They jumped from industry to industry until they found the right idea. And we often don't hear about that 1 or 2 years of a journey that these entrepreneurs went on to find the right idea. We only hear the last part and somehow connect that to, this founder had this problem when they were a child or something happened to them, and try to connect the dots like that. But oftentimes that doesn't exist. A similar thing to that is about having domain expertise in the same industry. I think a lot of ways we assess startup founders is, you're building an insurance company. How much do you know about insurance? Or how many years have you worked in insurance? Turns out that doesn't matter. Only 30% of consumer tech founders of unicorns had worked in the same industry. Only 40% of enterprise SaaS, unicorns had worked in the same industry. The rest, they had this skill of learning more than anybody else about the specific problem. They had the resources and connections and the soft skills to go on and know about that specific wedge into the market more than anybody else, even if they were not from the same industry. There's a lot more. There's about things about age. There are people who are looking for the 19-year-old, 20-year-old college dropout. There are people who are looking for the gray-haired, 2-3 decades of work experience. Seems like, again, age was not correlated with success. You can be 19 years old. You can be 68. I think that was the oldest that I had in my data set to start a company. And when you even compared it to distributions, the median age was 34 among, tech unicorns and 42 among healthcare and biotech, which seems a little bit older than, when I survey people or ask them, what do you think the average founder of $1 billion company when they started that company looked like? There's a ton. We can go on about competition, for example. A lot of people try to say we don't have competition. You're the only people. 85% of unicorns had competition when they started day one. In most of these cases, they were competing with big, sleepy, incumbent giants. They were competing with the Oracles and the Visas and JP Morgans of the world, rather than other startups. So, there's a lot. We can go on. If you have specific, thoughts about any of these topics you wanted to ask, go on, or, each of them are in the different chapters of the book. I go into details and provide examples and stories of the companies.
Yeah, no, this is, there's so many, I have so many questions. So, one really interesting data point I thought was the schools they attended. So dig into that a little bit more. I think there's this thought that, it's kind of Stanford, Harvard or bust. And it feels like you found something pretty different.
Yeah, so the data showed that school does matter. So that's one of the factors that is correlated with success. And, the typical Stanford, Harvard, and MITs, they do contribute a lot of, founding, CEOs of these billion-dollar companies. However, when you look at the full distribution, you see that there were as many founders of unicorns that had attended schools, not even in the top 100, as the same number as them had attended the top 10 schools. So it looks like a barbell. There's like 36% top 10 university founders, 37%, top, not even in the top 100, and the rest in the middle. So again, it is correlated, but there's a lot of hope. There's, 58% or 68% of founders of these billion-dollar companies did not go through top 10 schools.
Yeah, that's really interesting. So, what is there a Moneyball strategy here, right? Do people just pick up the book and then, make a really crazy spreadsheet and say, if you're a founder who's doing XYZ, take our money because you're statistically more likely to make me really rich. How do you think about, I guess, one, that for the gamblers in the crowd, and then two, how do you think about that just impacting your own investing?
For sure. So I think it's the reverse. We can become better investors by putting away our preconceptions and misjudgments about a specific founder or a company. It's amazing to go, there's a bunch of things the book showed it matters. Large industry, it does matter. Defensibility, it does matter. Previous work experience does matter. Being a former entrepreneur does matter. If you have previously sold a company for a small amount, that does matter. There's a bunch of things that the book, and the study found out to be contributors to success. And I will talk specifically about one of them, which is the previous, entrepreneurial things that you've done. But I think my goal with the book is to push the industry, ahead. Give a nudge to the other investors that if we put some of our preconceived notions about where the idea has come from, chip on the shoulders, somebody solving their own personal problems, what degree they have, we can become better investors by not saying no to the companies that go on and become billion-dollar companies. It's as important to say yes to the companies that are successful as not saying no to companies you see you have access to invest by reject for the wrong reasons. And I talk about all these wrong reasons to reject a company for.
What are some of the wrong reasons to reject a company?
Family members starting as a company. I see a lot of investors reject founders based on that. There's a ton of successful companies with 2 brothers, 3 brothers, father and son, fiancés, married couples. That happens and they're successful. Not investing in a company because they have competition, because what if Google does this, or what if, MasterCard does this? And in a lot of these cases, these startups end up becoming successful, or, not having domain expertise in a specific industry. What do you know about this industry? There's a lot of these reasons which might be wrong. What is important is the character of that founder, being able to sell the vision and attract super amazing people in the early days. One of the best examples of this, Katrina Lake of Stitch Fix, first 1 year, she attracting amazing talent out of Netflix, out of Walmart to join her as in the executive team. These are some of the factors that are contributors to the success of these companies.
Yeah. And talk a little bit more about, you talk about how early value creation matters. And obviously it's a little bit more nuanced than, hey, if you sold your first company for $1 billion, you'll probably sell your second for $2 billion. So, what do you mean by that early value creation, especially when it isn't, just you're already incredibly rich?
Exactly. So I think, when investors think about investing in serial entrepreneurs or, serial successful entrepreneurs, it's exactly what you say. You sold a company for $500 million, your next one would be $3 billion. That's normally what comes to mind. What I found is, that's obviously true, but it expands way beyond that. Founders, second-time founders were more likely than first-time founders to start billion-dollar companies. Second-time founders whose previous company was a small success, maybe it was an acqui-hire or maybe a technology acquisition, they were more likely to start a billion-dollar company next. Even people who didn't start venture-backed companies, started a side hustle and made $1 million. Started a project and, somebody wanted to buy that for, $500,000 or $2 million. They were more likely to start billion-dollar companies. What I found among these, successful founders was a never-ending itch for building something, for selling something, for creating, even not for money. I can give a lot of examples here. The founder of Cloudflare had started a nonprofit, spam email collection tool before starting Cloudflare. Founder of Calm, the $2 billion meditation app, which is very popular, had started this web page, the $1 million homepage, which was, 1 million pixels. He would sell each pixel for $1. A lot of people paid attention to it. He made $1 million. That was it. It wasn't a venture-backed, success. It was an exit. He made $1 million. Founders of Stripe, the $80 billion company now. they weren't first-time entrepreneurs, even though they became billionaires by the age of 20 something. Before that, they had to start a company, an auction management tool for eBay sellers called Octomatic that was acquired for $4.5 million before that. Founder of Spotify, he sold a company for, I think, $1 million before. Founder of Coinbase, he started, a company called University Tutor. Even the big people that we think are first-time founders. Bill Gates, Microsoft wasn't the first company. Trap Data was the first company. Zuckerberg, Facebook was the first company, but it wasn't his first project. He had started a bunch of projects and different apps before. One of them with Adam D'Angelo, the founder of Quora, which was a music player, Synapse music player. So you see this never-ending passion and itch for going out, creating, selling, and moving on to the next thing among these founders.
Well, in middle school, in high school, I would get in trouble because I would knit during class and then I would sell my knitwear. And so I would knit during class so people could see it and then get excited and they would pay me more. So I guess that means I'll be a billionaire soon, is what I'm hearing.
How can I invest?
Exactly. Don't worry, I'll send you the docs after. So no, I mean these are just such interesting insights. What's the thing out of all of this? What's like the one data point that surprised you the most?
If I were to say about one, I would say competition. 70% of these unicorns were not creating a new category, and they were competing for share in an existing market with better execution. I think a lot of us are thinking about, you need to be creating a whole new category from zero. You need to be Coinbase. But turns out a lot of these billion-dollar companies, the majority of these billion-dollar companies are doing better execution in a massive market. They take market share and they become big. And actually, on average, they have created larger companies than new category creation companies, which seems a little bit counterintuitive to me, but it's not. Same thing on being a first mover. Only 30% were first movers, 70% were not. And they were just recycling old ideas that became successful at a different point. And when they became successful, it was because of an inflection point in terms of regulation or in new technology.
No, that's super interesting. I'm thinking through,
That was going to be my follow-up question about competition. Is
well, what is it then, John? What's your follow-up?
Do you think there's a reason for that? The competition piece. Do you think competition makes people better? I think about Stripe as an example, and they're in sort of a commoditized space where you have Adyen, you have PayPal, you have Square, you have Authorize.net. There's all kinds of different ways that you can take payments. But Stripe has just continued to aggressively innovate around all the data and information that they gather because they're the main point of sale. That's just one example. But do you think competition, breeds excellence type of situation? Or what do you think the drivers of success in a more competitive environment, as opposed to that moat concept that somebody like Warren Buffett talks about when he invests?
For sure. I think competition from good big companies is a sign that that market is large. And you want nothing better than a massive market, that the customer is educated. Somebody has paid the price to educate the market, to take the market timing risk. And at this point, it's a massive market, customer is educated, and you can just go execute better and sell. And obviously, it does drive innovation and a lot of excellency in the way these companies operate. But I think the biggest thing is it's a sign that the market exists and it's large.
Yeah, almost like if you start a company and there's nobody trying to do anything resembling what you're doing, maybe you're solving for a problem that doesn't exist.
Exactly.
It's an interesting way to think about it.
Yeah.
Go ahead, Sarah.
That is a super interesting way to think about it. How much do you feel like, so I guess, how long did collecting all this data and writing the book take you? And what changes have you seen in your own investing since sort of, before you started doing this or before you kind of, started digging in and then now after you see these findings?
Yeah, it's a little bit over 4 years. So the data collection piece took 3.5 years, and the writing the book piece took me 1 year, and the interviews and stuff. So, the hardest part was data collection. It's 30,000 data points. You can't outsource it. You can't automate it. It requires a lot of judgment, reading, cold emailing, surveys, a lot of different, things to collect this data. So that was the longest and hardest part. And then the interviews were the most fun part because I got to, talk to all these amazing founders and investors. And again, the little bit hard part at the end was editing and finishing and making it into a book. The way this has changed my thinking, I think number one is to not let my judgments come into the way of backing a great entrepreneur. You don't need everything to check out for a company. You don't need everything to be good about a company. That's not a recipe for investing in the best company. You need one thing to be exceptionally good, and that the other pieces may fall, into pieces, or that the other pieces would fall in, and the company would work out. So that's one. The second is, again, instead of looking for what company you worked at or what university you come from, these kind of stuff, look for this characteristic of, what have you sold before? What have you built before? What type of money did you make before, coming and starting this company? And I think you can get a lot of information about the characteristics of these founders rather than proxy metrics like university, where you worked, and these kind of stuff.
I love that. Characteristics, not proximetrics. I like it. How do you think, there's obviously in our industry sometimes a lot of bias in terms of who gets funded and who doesn't. How does this data help sort of disrupt that? Because, that the pattern matching that everybody talks about in our industry, I think your book is a great point that it's not that pattern matching it's bad. It's just that most people are probably matching, the wrong patterns. And so how do you think this helps, kind of expand the aperture? Or does it help expand the aperture of who should be looking at getting funding?
For sure. Yeah, I guess the point is, instead of letting 10 or 5 famous stories run that, pattern matching, let 300 companies run that pattern matching. So by showcasing, I think I have 100 stories from 100 different companies in the book, all different examples, all different interviews. So I hope, this helps show a lot more examples of some of these companies that went on and became successful. And sometimes against the odds. A lot of my interviews is, companies that succeeded even though they didn't agree with what the data was saying about them. So I wanted to give the full picture about, there's pattern, there's anti-pattern, there's a lot of different things that may work, even at the odds with data. I think the main way it can reduce bias is with, telling investors and entrepreneurs that a lot of things you may have cared about before, you don't necessarily need to care about. How many co-founders you have, what university you went to, a lot of these things, or if you're family members, or if you have competition with, and this depends on what type of competition. But if you go and look into a lot of these, patterns and factors, you realize you can put aside some of your judgment or wrong bias against, and look for characteristics, look for a big market, look for, some sort of defensibility or accumulating advantages that would make this company a massive success.
I got a question, Ali. It's about geographics. I want to dig more into that question. So if you're on Twitter, you have to see Keith Raboy every day and all of his minions pumping up Miami as the next big tech hub. As everybody's got to move to Miami. Obviously Silicon Valley's had a high concentration of startup founders, of talent, of VCs, but that's sort of decentralizing, COVID acting as an accelerant for that. As you looked at data around geographic location and what types of areas incubated the most successful startups, what did that data show? Did it show that it's more decentralized than we think it is? Or did it show that Silicon Valley dominated it? And also, as you look globally, is there any explosion in entrepreneurship around the world? I think you and I both have spent some time in the Middle East, in the UAE in particular, where there's a pretty thriving startup ecosystem that's developing there. But what are your thoughts on the geographic piece?
Yeah, so when you look at the data, and you have to pay attention, this is historic data. So I'm not sure, given everything that happened with COVID, distributed work, remote work, everything was accelerated towards this. So I'm not sure how predictive the data would be, but I will tell you the historical observation. Historically, or in the past 15 years, exactly half of billion-dollar companies were created in Silicon Valley. The other half were created in different tech hubs, Southern California, New York, Boston, and a lot of different regions that you can think about. In the book, I have a number of interesting interviews. One of them is with Rachel Carlson, founder of Guild Education. What's very interesting about her story, and this is a multi-billion-dollar company in the upskilling and ed tech space, that she was in Silicon Valley. The company started here, raised money here. She was a Stanford MBA grad, and then intentionally moved the company to Denver, which is not a traditional tech hub. And the company thrived there, and she's very happy with the decision, looking back 5 years, 6 years after. So I think a lot of this move towards, let's go out of Silicon Valley, let's go where it makes sense for the company. I talk about root insurance, which is, not in a Silicon Valley tech hub, but it's where there's a concentration of people from the insurance and insurtech industry. So I think you need to look for what's better for your startups. But, when you look at the data, the companies in Silicon Valley, they were more likely to succeed. So there seems to be something about concentration that helps, or historically have helped. Now, maybe that thing can distribute to other tech hubs that get enough concentration of talent. It could be Miami, it could be Boston, it could be New York, or anywhere else, or even internationally. But it seems like, at least historically, there was something to that concentration of talent and capital. Maybe in the future that doesn't remain. I don't know the answer to that question.
Well, I'll look forward to Super Founders 2, the sequel to Super Founders, where you study sort of the post-COVID era. Steve Case, who's a friend of Salt, who's been on Salt Talks, who's been at our conferences, he has a fund that's invest in the idea that, at least in the United States, you're going to see a greater distribution of talent and startups in the rest of the country outside of Silicon Valley, and also New York are the places that he looks for startups outside of those places. And you see companies like Palantir, move to Denver, for example.
Yeah.
So you are seeing, people relocate and look for higher quality of life with the ability and the explosion of remote work. So again, looking forward to Super Founders 2.0. Get started. 4 years in the making, right, Ali? 4 more years.
Yeah. Yeah. Hopefully I'll spend another 4 years in 10 years.
I did in the last 4 years, I created 4 children. So I need to spend more time, maybe working.
That's prolific. Actually, yeah. Do you have any data about family? How many founders are parents?
Oh, I don't want to hear it. You're going to tell me that my career is doomed now because I got too many kids.
I don't know the answer to that. And probably not, because, when the median age is 34, you can make some assumptions about the family situations of these founders.
Yeah, that is very true. That is very true. Well, sorry, John, you're doomed. But maybe one of your kids will have a great chance. Actually, that's another interesting question. Are there correlations like that? I know that, it seems like a lot of times founders feel like, hey, I started my company because I saw, I'm from an entrepreneurial family, and it usually is not that they were a tech startup family, but, maybe their parents owned a restaurant or something like that, or you hear a lot about, the disproportionate number of immigrants who start companies. Are those things that I think even founders believe about themselves? Are those showing in the data, or is that less important, or just not stuff that ended up in this data set?
It did not. The hard thing about doing a study like this is you need to pick metrics that you can collect that data on all these, couple hundred companies and the non-unicorns. And it's impossible to do things outside of, traditional things like, what you can get from LinkedIn and interviews and these kind of stuff. Maybe you can get about 20 of them, but not all 500. So it didn't. From the stories, I guess it does. Hearing a lot of these entrepreneurs, seems like a lot of them come from families who were academics. A lot of them had, moms or dads who were professors, or who were entrepreneurs who had started, non-tech companies, and they had seen that path. But I guess what's more important than that is they themselves had a history of starting stuff and building companies and projects from a young age. And, finally and eventually they got to starting that massive $1 billion outcome.
Yeah.
So, and one of your key findings that you talked about, Ali, is the idea that most unicorn founders had no industry experience. So I work in the financial industry. Skybridge is basically a hedge fund, a fund of funds. We also do some direct investing as well. I guess you could consider us a legacy financial institution. We work with a lot of, traditional banks, but you're seeing an explosion in fintech. This was happening even before COVID. COVID has been an accelerant for fintech. So when companies are going into a new space, you think, basically based on your data, that the idea that you're coming in with a fresh perspective, let's say the financial industry is an example, most fintech startups are created by people that didn't grow up as an investment banker at Goldman Sachs or a wealth manager at Morgan Stanley.
Yeah, and again, when you look at the distribution, it doesn't say you are less or more likely if you don't like. It's not a good thing if you don't have domain expertise. It's also not a good thing if you don't have domain expertise. Right. You know, just 30% of consumer tech founders did have domain expertise, and only 40% of SaaS enterprise did have industry domain expertise. But it goes back to the characteristic thing. When you look at a lot of these founders, they had the resources. Maybe they had some track record. Maybe they had, had this small exit before. They had built that reputation to go and network with people in this industry and go on a fast learning curve of, in 1 or 2 years, learn more than anybody else about that specific part of the specific industry that they wanted to go and disrupt. They would know about that more than anybody else. They would know more people on that more than anybody else. And it's those kind of soft skills about having the resources and the network and getting the talent and capital and selling your vision that's more important than having 10 years of experience as a wealth manager to be able to come in and build a wealth management software company, for example.
No, that's really interesting. I feel like what you're telling us is there's not just a cheat code where we can go identify billionaire, soon to be $1 billion startups, but it's so important, I think, to question some of the things we take for granted. How long back did this data go? Meaning, is this data a big reflection of like the last 10 years or the last 20 years? And how much?
15. So 2005. Yeah, 2005. The start was the start of this data set. Yeah.
And how much do you think, what do you think would change? Obviously the internet's changed so dramatically since pre 2005, but do you think if you ran this again 15 years from now, you would see a lot of similar data sets, or are there, massive, in your mind, fundamental kind of macro shifts that might, show that totally different profiles of founders are successful?
I think some things would change. Certainly the names and numbers would change. The companies. So for example, if you look at the early cohort of the 2005 to 2008-9 companies, those founders are more likely to have worked at Yahoo or at Oracle. When you look at the past 5 years, those founders are more likely to have worked at Square or Facebook or Stripe. So that's the kind of, a lot of these numbers change. Or, what was a seed round back in 2005 is a pre-seed round now in 2021. So a lot of these numbers change. But even when I look at different industries or geographies or different times, a lot of these trends and a lot of these characteristics are still the same. It's the same people who had a bug for building back in 2005, then they are the same people in 2020 that had a bug for building and had created stuff that end up becoming billion-dollar founders. Same thing about competition, same thing about a lot of different things. Obviously, industries change, new categories emerge, new macro shifts like geography and remote work can, alter data. But I think generally a lot of these may hold.
Yeah. Yeah, no, I instinctively, I'm inclined to agree, but we'll see because we have all the data now. How do you hope people will use this book? I mean, should founders be reading this to try to reverse engineer success? Should investors be reading it to do the same thing? How this feels like it's going to become a must read and a big teaching tool. So also, of course, tell us where we can find it and where we can buy it. But would love to just kind of know how you envision this being used out in the world.
Yeah, I hope, founders, investors, and people around the industry, lawyers, mentors, advisors, accelerators, incubators, investment bankers. I think that's the audience for this book. And anybody, honestly is interested in starting companies and entrepreneurship. And the way I think, there's a lot of practical advice for founders in the book based on the data that, this is something that doesn't matter. Maybe, number of co-founders doesn't matter. So if it means that you have 4 amazing people to start a company, start it. Don't stick to the narrative that you need 2 co-founders. So a lot of these things I talk about in the book that, if something doesn't matter, don't sweat it. And, same thing for investors for, reducing bias. And there's a lot of inspiration in these stories and interviews that, I think as a founder, it would be very interesting to read and understand the path that, these couple hundred other companies took and these founders took to become a massively successful founder.
Awesome. Yeah, that's super helpful. John, do you have any last questions?
Well, my last question is, when does the book come out? Where can we buy it? Tell us all that about super founders.
Yeah, so the books come out May 18th, just hit the shelves. It's available on Amazon, Audible, Kindle, local bookstores. You can read it in different versions and US and outside of US as well, a lot of different
Did you
countries.
dictate the Audible version?
I did not. No, there's somebody who has a much better voice and accent than me that's doing the honors.
All right. Well,
I think you would have been great at it, but
yeah,
everybody needs to go get this book, and maybe we can get you to New York in September for the SALT conference, and everybody can hit you up for advice on how to invest in the next unicorn IRL.
For sure, I'll be glad to.
All right. Again, the book is called Super Founders: What Data Reveals About Billion-Dollar Startups. Really looking forward to reading it. Ali, thank you so much for joining us on the show. And thank you, everybody, for tuning into today's SALT Talk with Ali Tamaseb of DCVC. Just a reminder, if you missed any part of this talk or any of our previous SALT Talks, you can access them on our website at salt.org/talks or on our YouTube channel, which is called SaltTube. Just a reminder, we're also on social media. LinkedIn is where we're most active at SALT Conference, but we're also on Instagram, Twitter, and Facebook as well. One data point that Ali didn't point out is that people who watch SALT Talks are actually 74% more likely to become unicorns. That is unaudited, unverified, but it's a snippet that's in part of his book. I'm not going to tell you what page it's on, but thank you, everybody, for tuning in, and please spread the word about these SALT Talks. But on behalf of Sarah and the entire SALT team, this is John Darcy signing off from SALT Talks for today. We hope to see you back here again soon.